Whether you're a seasoned pro or a beginner, I guarantee you learned something today. We're talking all about ETFs versus mutual funds and why you need to understand both of them. You don't want to miss today's video. How's it going, guys? My name is John Boyd. I'm a certified financial planner and I'm the founder and lead wealth advisor at Modern Wealth. If you like today's content, be sure to hit that like and subscribe button to keep getting content just like this. And of course, if you need help with your own financial plan, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. So today we're going to be highlighting some of the key differences between ETFs and mutual funds and why both of them could have a place in your portfolio. But first, before we dive into the key differences between them, let's talk about what they both have in common. Mutual funds and ETFs are both baskets of securities, and the reason why you'd want to own a basket of securities is for diversification and it's less capital intensive. For instance, if you could own all 500 stocks within the S&P 500 for less than $100, that is a great way to own tons of different companies, have lots of diversification, and pursue long-term growth. Mutual funds and ETFs enable you to own broadly diversified baskets of securities just like this, but it's not just with stocks, it's also with assets like bonds, commodities, options, real estate, and more. So, if they are both broadly diversified baskets, why does it matter which one that you pick? Well, let's talk about some of the key differences between ETFs and mutual funds. ETFs tend to be passive investment vehicles that track an index. With mutual funds, you can find plenty of passive index funds, but you're also more likely to find active strategies in the mutual fund family. So, for example, if you wanted a fund that actively seeks out small cap stocks with great growth potential, you are more likely to find a mutual fund that does this rather than an ETF. And the reason for this is that ETFs tend to be more passive while mutual funds tend to be more active. And this leads me to point number two, and that is ETFs tend to have lower expense ratios. Because ETFs are generally more passive and less active, they are therefore cheaper to operate by the fund manager. This drives down the overall cost of the fund, whereas mutual funds, on the other hand, tend to be a little bit more expensive. ETFs also tend to be more tax efficient. Mutual funds are more likely to spit out an end of year capital gain distribution, while ETFs, on the other hand, generally do not. ETFs also trade on stock exchanges, so this means that you can track the price of an ETF in real time during market hours. Whereas with a mutual fund, they generally are only priced once per day at the end of the day. This also means that because ETFs trade on stock exchanges, you could potentially buy and sell options contracts on them, whereas with a mutual fund, you cannot. Finally, ETFs generally don't have investment minimums, where mutual funds do. Your barrier to entry with an ETF is the share price. If you can buy a share of an ETF, you can buy into the fund. A mutual fund, on the other hand, could be valued at $25 a share, but requires you to have an investment minimum of $3,000 to even invest in the fund. So, those are some of the key differences between mutual funds and ETFs. And if you have heard those key differences, you're probably thinking, well, if ETFs are lower cost, easier to buy, and can even be more tax efficient, why would anyone ever buy a mutual fund? Why would I not just stick with ETFs? And quite frankly, I agree with you on a lot of those points. ETFs are awesome, and the growth of ETF investing has created greater liquidity and increased investment options with ETF investing. And in full transparency, my firm, Modern Wealth, tends to favor ETF investing. However, there are plenty of times where it makes sense to go with a mutual fund instead of an ETF. Here are a couple examples of where that might be the case. So, one reason why ETFs are so great is how easy it can be to buy into them. You can just hop on your favorite investing app and within 60 seconds buy shares of your favorite ETF. But just as easy as it is for you to buy into it, it's also that easy to abandon ship on an investment. And during times of significant market volatility, this can negatively impact your returns. To understand this, take a look at this chart. This is a chart of the iShares investment grade corporate bond ETF. You will see prior to the COVID sell off in 2020, the market price of the ETF which is the yellow line, and the net asset value of the ETF, which is the underlying value of the investments within the fund, indicated as the dark blue line, you can see are pretty much exactly the same leading up to the sell off. Once markets sold off, you can see that because investors started to sell out of the fund and abandon ship all at the same time, this dragged down the price of the ETF. Even though the underlying investments were worth more, the value of the ETF fell lower than this. And in the example of this bond fund, this is a huge issue. You bought the ETF because you thought it would be more stable in bad times, and the price ended up falling more than it should have because everyone ran to the exits at the exact same time. Investing in a mutual fund in this example could have helped mitigate this risk because mutual funds are not on highly liquid stock exchanges. The second reason why you would perhaps go with a mutual fund over an ETF is the fact that you can pursue more active strategies and get access to different asset classes with a mutual fund. Now, many that hear the word active think passive is better because it's cheaper and it always outperformed active strategies. Why would you ever need an active approach? Well, this isn't necessarily the case for all asset classes. For example, I quoted this study in a different video, but there was a study done by Fidelity Institutional that did a study on the performance of actively managed bond managers versus the index. And the study found that in the majority of cases, the active manager outperformed the benchmark across multiple different bond categories. If you are looking for a more active approach with maybe the fixed income portion of your portfolio, maybe choosing a mutual fund over an ETF could make more sense. In addition to this, if you are someone who wants access to alternative asset classes like private real estate or private credit, it's going to be much more difficult to get access to those type of assets with a traditional ETF. The final reason why you might want to invest in a mutual fund over an ETF is the ETF you want exposure to is thinly traded. This is a legitimate issue in the ETF marketplace. Because ETFs trade on a stock exchange, you need to buy them like you would a stock. When you buy a stock, you need to understand how much someone is willing to buy it for, the bid, and how much someone is willing to sell it for, otherwise known as the ask or the asking price. If a stock is thinly traded, the spread between the bid and the ask can be large, impacting your ability to exit the position. And this can inevitably cause you to sell at a much lower price than you thought and buy in at a much more expensive price than you initially anticipated. This same issue can happen with ETFs that are more thinly traded. Bottom line is ETFs are great and can help be a solution for a lot of your investment needs within a portfolio. However, mutual funds have their place too and can be more beneficial in certain circumstances. I hope you guys found this video helpful. Be sure to like and subscribe, and I will see you next time.